Inflation is hotter than expected. Producer prices came in higher than expected today. So did the consumer prices earlier this week. Producer prices show what producers pay to make goods, which ultimately affects consumers. Consumer prices indicate the average cost of living. David Stryzewski, CEO of Sound Planning Group, joins me now. David, good to have you back. So the inflation battle seems more complex than many had assumed. Are you concerned about the possibility of inflation re-accelerating?
Hey, well, great to be with you as always, Alicia. Yeah, I've been very concerned about inflation re-accelerating, but it's important to understand some things here. You know, when we have over 500 union strikes last year, it's because everyone can't keep up with the cost of living, and so they need to demand, a higher rate. That's going to come to us as consumers in the price of higher prices. When ships are going around Africa, that's very inflationary. When there's continual printing and printing and printing, I mean, Milton Friedman gave us this example and said there is not a single economy in the world where inflation exists that printing is not also existing. And so we know what causes inflation. It is printing. We can't seem to get off the printing press right now, and it does not seem like we're going to be able to turn this thing around.
Yeah, good way to put it. Even with inflation ratings coming in hotter than expected, the mainstream narrative wants us to focus on inflation moving in the right direction, which it is. It's down from that record high over 9% about a year ago. But inflation is up almost 18% over the last 3 years. It's according to the Bureau of Labor Statistics. And real hourly earnings are, on average, lagging behind that. Credit card debt hit a record high of $1.13 trillion. Providing context, while the stock market has seen gains and jobs are returning from lockdowns and consumer sentiment is up, possibly influenced by the hope of rate cuts soon, which we'll get to more in a second. How much more are families paying for essentials compared to last year and 3 years ago?
Well, what a great question. So there's a difference first between disinflation and deflation. Disinflation is what we've been seeing. So we went from that 9% mark that CPI gave us, and now they're saying that we're somewhere around 3 right now. So that's inflation going lower, but that's only new numbers going forward. So your question is very important, which is how much more are we paying cumulative inflation? How much does it cost everybody? And so ultimately, if we look back over the last 3 years, according to Trueflation.com, which I personally believe has a better number, 23% is the actual lift or the increase in costs. I mean, I weigh about 200 pounds. That's the difference of putting an extra, 50-pound weighted vest on and going for a run. Pretty tricky to figure that one out right now. But, over the last year, we've only been seeing, somewhere around like 2 to 3%, according to the CPI numbers. Now, I'm just going to note this. Everyone's inflation or their CPI is actually going to be different. I mean, just think about it. If the biggest part of your income was or your expenses were a fixed mortgage, well, a fixed mortgage doesn't go up every year. But if you're trying to pay rent, well, we've seen rents go up. We're seeing, gas prices wane a little bit right now. But if you're on Teslas and you're doing electric vehicles, maybe that's a different thing. So your personal CPI is a more important number. And we think that that's reflected in more like that 25% to 30% increase of cost of things here the last few years.
Is there a specific number on average, like how many hundreds or thousands more families paying for essentials?
I mean, I can tell you this much right now. It looks like we're basically only getting paid for about 9 months worth of our work. Think of like a fourth of our year, 3 months of our year where we just don't get paid anymore. I think that that's a really important way to look at it. But the average family is probably, down somewhere about, $800 to $1,200, kind of depending upon the report that we look at. So it is not a great thing right now, which is why the credit cards have been driving up, just like you just noted.
Right. Consumer sentiment has been increasing, maybe because of the hope that the Fed is going to cut rates soon here, possibly in the summer. And now there's growing debate about the timing and extent of these potential Fed rate cuts. How do you anticipate the Fed navigating this year?
Okay. Well, I have a strong belief that the Federal Reserve is telling us exactly what they're going to be doing right now. And that is that they're going to be higher for longer. And so we didn't believe this 6 or 7 rate cut theory that everyone was on here coming out of the December meeting with the Fed. In fact, I think the Fed jumped the gun in December, and they basically said that their rate hiking cycle was done. Well, that's actually potentially not true, as we just saw these CPI numbers kick up. So really, there's two choices here for the Fed to make. Either they're going to remain this higher for longer, but they could potentially kill the economy in the event that they were too high for too long and it really crashes things, or they commit the Volcker mistake, which is by cutting too early. And so I think that they're very conscious of the cut too early, as they're very data dependent. They're going to need to see multiple reports in a row that show that interest rates are dropping. And so I don't see this happening anytime soon. And let me share with you why I think that this is a really big concern. Because next month we hit the 1 year since we got into our last banking crisis. And what happened was that we created this Fed pay system where the banks were able to exchange bonds that were, had major losses, like 30% losses, and they were able to exchange them for 100% value. So this is coming up next month, while simultaneously we're seeing the biggest amount of corporate debt come due in March of 2025. Well, David, it's 2024. Here's why this is important. Understanding the basic accounting principle that corporations have to abide by. The day that it becomes less than 12 months till that debt is due, that becomes a near-term or current liability. Why is that a big deal? Because I think as corporations are looking at this, they are not expecting big cuts like maybe we were hearing just a couple of months back. They're ultimately going to be looking at, maybe defaulting here or letting go of a lot of employees where they may not have had to otherwise do that last year when the numbers looked better for them. So again, if these current liabilities, debts, are not going to be repaid, they are going to be, borrowing at 9, 10, 11, 12% in order to try to get debt done. And that is very difficult on the margins of these corporations, meaning they're going to make a lot less money. And so I anticipate as we go into the second part of the year, you're going to see a lot of those numbers showing up.
Yeah, a lot to keep our eye on, and you're helping us do that. David Stryzewski, CEO of Sound Planning Group, thanks for your time today.
Pleasure's mine. Thank you.
Of course.